Hello and welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne, and in today's episode, we'll be answering more of your money questions. This week, we'll be looking at things like what types of credit cards can you use to earn rewards, and can you open an ISA if you live abroad? Stay tuned to find out more. This episode is sponsored by Saxo Markets. So our first question comes from Arthur. Arthur says, I'm a UK citizen and currently live in the UK, although I spend much of my time working in Europe. I already have a few savings accounts with my UK bank, and I opened a cash ISA last year. I'm now looking to open a stocks and shares ISA and would appreciate some tips. Well, Arthur, thanks so much for sending in your question. So if you haven't done this already, do be sure to double check the residency rules around your ISA that you already have open before looking into getting another one. So you want to make sure that your ISA is in the correct state. Once you move abroad and you become a non-UK resident, you can't actually put money into your ISA unless you are a Crown employee, so a civil servant, or you're the spouse or civil partner of one. So you can pay back into the ISA once you return and become a UK resident again, but you must tell your ISA provider just to make sure that everything is crossed off. So assuming that you are eligible to keep your ISAs open and open a new stocks and shares ISA as well, the best thing to do is start shopping around and comparing different providers. We have a handy tool that can help you figure out what type of stocks and shares ISA might be beneficial for you, which I'll link in the show notes. Once you've had a look at that, gotten your results, take a look at some of the providers and if they align with your investment goals. So the types of investors that you might come across are those who want to keep their costs low. Some might want to have more agency over the types of investments and the way that they're organized in their portfolio. And some might want a more laid back approach where you put the money in and allow the platform to do the rest. Obviously checking in now and again to make sure it's aligned with your goals and the amount of risk you want to take on. Once you've got an idea of that, you can then start going through different comparison pages. So looking at, best stocks and shares ISAs and working out what types of platforms might suit you in the long term. Do you want something that has a really handy app that you can use on the go? Do you want something that has more of a powerful interface that you can use on PC where you can really get into the nuts and bolts of investments and the different market news and things that might influence the value of your portfolio? Once you have an idea of those and you've narrowed it down, then you can move on to the next stage of making your application, submitting the documents that you need, and opening your account and getting started. It's really important to remember that your capital is at risk when you invest. So that means the value of your portfolio or, the investment assets that you have can go up and down. And you might not have the same amount of money that you put into your investments at the beginning. So having a longer term focus of 5 years or more for the things that you're investing in allows time for your investments to recover from things like market shocks or a market crash where there might be a bit of a dip. I hope that helps. Our next question comes from Danielle. Danielle asks, what are the best credit cards for travel and leisure perks? That's a great question. And with summer being in full swing at the moment, really great time to start thinking about earning different types of rewards and making sure that your spending helps boost what you get back. So the different types of reward credit cards that are available, some offer you points. So every time you spend, you might get a certain amount of points back. Some allow you to earn air miles. So that's specific to traveling. One of the travel point operating services at the moment is Avios, and that allows you to earn a certain amount depending on which card provider you're with, which you can then use for things like your flights. You can also put it towards your hotel stay, activities, experiences as well. if you have a credit card that allows you to earn cash back when you spend, what you can do is funnel that money that you get back into a savings account and then use that money for your trips and travel spending as well. Things to really keep aware of when you're using credit cards. The first thing is don't borrow more than you can afford to pay back. It's really important that you can afford your credit card repayments. If you don't keep up with them, it can have a negative effect on your credit score, missing payments especially, and that can lead to a lot more financial trouble in the long run as well. It is really important to try and make sure that you clear your balance all at once as well. Credit cards can be very expensive, and the interest that builds up on your debt can make it a lot more expensive to pay off in the long run as well. So even though you might get the option to only pay off the minimum amount each month, trying to pay more than that, the best case scenario, clearing that balance every month, helps make sure that you can pay it all off and make the most of the rewards that you're getting. Because the last thing that you'd want is for the debt that you accrue on the credit card to outweigh any of the benefits that you get. So just making sure that you can pay back what you borrow, use your card responsibly, then you'll definitely be able to make the most of the rewards that you get back and put them towards travel and flights, hotel accommodation, the different things that come together to make an amazing trip. This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. Our next question comes from Joanne. Joanne asks, is a stocks and shares ISA the best way to save? That's a really interesting question, Joanne. So a stocks and shares ISA is designed to help you buy, sell, and hold investments. And those investments sit within the tax-free account, which is a stocks and shares ISA. Your allowance currently is £20,000. Now, with the stocks and shares ISA, it's designed for those investments rather than for you to save. So when we think about saving, it's generally for longer term financial goals. So things that are around about 5 years or more away. You can use it if you have a shorter investment time frame. It completely depends on your strategy and like the goal that you have in mind. But generally speaking, it's for financial aspirations that are slightly longer term. The reason for that is it gives your money time to recover if there is a market shock or a market crash and the value of your investments goes down. It just allows that time for it to recover and you to get the best return possible. So when thinking about saving specifically, say, for example, if you are putting money away for the very first time, you're trying to build up an emergency fund, or you need the money in a shorter space of time, say within the next few months, next year, couple of years, the types of accounts that might benefit that type of situation are more savings accounts. Or if you would still like to benefit from the use of an ISA, you could use a cash ISA as well. So the cash ISA makes up £20,000 of the cash ISA limit at the moment. However, that's going to fall for cash ISAs to £12,000 from the 6th of April 2027 for under 65s. A couple of options to consider, but having a look at those types of accounts and whether they might be more suitable for the financial goal that you have in mind. So again, when you think about having an emergency fund, it's something that you can access very quickly to put towards whatever unexpected cost has come up. So if your boiler breaks down, you run into car trouble, or you have a last minute trip that you need to make to visit family or something like that, you have that pot of money ready to go and it's accessible, easily put to use. Have a look at the different types of accounts on offer. Have a think about what might be suitable for your aspirations at this point in time and see what might work best. If you are thinking about something a bit more long term, say, for example, you're thinking about purchasing a property, or even for something like retirement, potentially going traveling for an extended period of time, and it's a lot later down the line. So, 5 years or more down the line, potentially investing could help you build up what you need and help deliver a greater return. But it's about weighing up what it is that you're putting that money aside for, when you need to access it, and how long you actually have to bring it to fruition. Our next question is from Millie, who asks, do you pay tax on investments? So, very interesting, quite linked to the previous question, actually. And the simple answer is it depends on where your investments are held. So, if your investments are held within a stocks and shares ISA, the current limit, tax-free limit on that is £20,000. And the returns that you earn on investments within that ISA are shielded from tax as well. However, you don't have to have your investments in a stocks and shares ISA. You could have them in a general investment account, and they may still get the same level of growth. One thing you do need to bear in mind is that it will or possibly be liable to other taxes. So things like dividend tax, capital gains tax, and income tax as well. The amount that you'd need to pay depends on how much your investments have grown and your wider financial circumstances as well. So to figure out whether or not you need to pay that, you will need to submit a self-assessment tax return to make sure that you are hitting all of the things that need to be paid and keep them on the right track as well. So when thinking about investing, you aren't just limited to a stocks and shares ISA, but it is really important to understand all of the different taxes you're liable to pay depending on the account that your investments sit in. And our final question for this episode comes from Reese. Reese wants to know, what's the process for putting a lump sum into your pension? I'm about to start a new job and was thinking about it. So, Reese, that's a really interesting question. The process for putting a lump sum into your pension depends on your pension provider. So, the first port of call is to get in contact with whoever your pension is sitting with at the moment. You can do this by looking at your previous pension statements. They can come through the post. Sometimes they're delivered to your email box. If you can't find anything, get in touch with your HR department and they should be able to link you with the company that your pension is sitting with. Once you've got an idea, get in contact with them and they'll let you know the process for putting that lump sum into your pension. What's really interesting about your question is that you are about to start a new job. So you, at the moment, could be contributing to the pension with either your current or previous workplace. I guess you also have the option of paying a lump sum into your new pension. The process would be the same. Another thing that might be worth considering is whether or not you might benefit from combining your pensions. So this is known as pension consolidation. And essentially, this allows you to simplify all of the different pension pots that you have. So instead of having lots spread around, you combine it into 1, 2, maybe 3 or so pension providers. This kind of helps, again, just create a bit more simplicity, makes it easier to manage. It potentially could lower the charges as, each pension has its own set of fees. So you could consolidate them into something that just helps reduce that impact on your retirement income later down the line. You might be able to increase the amount of investment options depending on which provider you consolidate into. And it just simplifies the idea of financial planning. Thinking about pensions, thinking about retirement, it can get a little bit complicated. So having lots of different pots spread around is slightly more difficult to manage than having a smaller sum that you actually are able to have a look at, make tweaks to, and decide whether or not the strategies are working for each one. There are a few risks to be aware of. So with consolidating pensions, sometimes you might lose benefits depending on the type of pension you have. So the two main types of workplace pensions are defined benefit pensions And the newer and sort of more common ones that you see now are defined contribution. So defined benefit pensions usually come with, additional benefits, potentially from employers. And sometimes when you transfer out of those, you might lose some of those benefits that come with it. It's important to kind of understand what type of pension you have and just make sure that if you do decide to transfer and combine them together, you're not going to lose anything in that process. Another thing to be aware of are exit fees. Some pension schemes charge fees to transfer your funds from one place to another. That's another thing that can have an impact on your final pot. So really important to keep an eye open for that and make sure that it's not going to negatively impact your pension pot over time. And also, if there are any employer contributions, so for example, if you transferred your new pension into your old one, there may be an issue around your employer contributions. So you just want to make sure that whichever way that you're making the consolidation or doing any transfers, if you think it's a good option for you, just make sure you're not losing out on anything, particularly any benefits or employer contributions, which are incredibly valuable, particularly in the long term. And remember, you can always get the best of both worlds and try a partial consolidation. So that allows you to combine some of your pension pots and, keep higher value pensions separate just to make sure that you retain any benefits or extra perks that come with it. So a few options to consider. If at all you find yourself thinking this is very complex and, you're really not sure what to do, try and get in touch with your employer and see if you have any benefits through your employer that allow you to speak with an independent financial advisor or a pension specialist, which will allow you to sit down and really go over your specific circumstances and work out what might be the best option for you. And remember, when it comes to things like pensions and finances more generally, it's important to keep doing check-ins as time goes on. Some options can be tweaked along the way. So if you decide to, not necessarily consolidate now, you just want to pay your lump sum in, that's fine. You could leave consolidation for a little bit down the line when you feel a bit more confident and ready and know which way you want to take your strategy. And, you might consolidate your pensions after this and then decide that you want to transfer to another provider because they offer something that's a bit more aligned with the investment strategy that you have in mind for your retirement pot. So even though, you're making decisions about it, remember that it's important to stay engaged and have a look at how things are performing, have a look at whether or not your retirement fund is on track for the lifestyle that you want to have when you decide to stop working. And just make sure that it's all aligned and ready to go. Thank you all so much for sending in your questions. Remember, if you want your question answered on the show, just send it in to podcast@investinginsiders.co.uk. Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.